So here we're going to look at the NQ, one of the faster markets going around. There are a number of Norton Method traders that I've taught over the years that are trading NQ very well. It's a market that I think that most traders are going to trade poorly, mainly because they're using levels, absorption, that kind of thing. This is a market where using levels is going to hurt you. Really, there's a high level of randomness to this. There's a lot of orders just being put in at market, and they're getting filled everywhere. Interestingly, I think that one reason why people are fooled into levels in markets like this is the fact that it's in round numbers. As you can see, 25, 50, 75, 00. The round numbers mean that people are going to see things bouncing off of 00 or 50 and think that it means something. It's just the way the technical traders are taught. But there's a fair amount of randomness in this. It just happens to be that they're all round numbers, so the market of course is going to bounce around off round numbers. But basically for us as Norton Method traders, we look at the last print. Where is value? Where's it going? Can we get in on that and trade around that last print? So if we have a look here, market's been trading up. It's trading very fast. Notice how the trader here comes in a number of ticks below, which is the right thing to do. This market is moving 4, 5, 6 ticks at a time. You need to come in with your orders 4, 5, 6 ticks away. Sweeps down and fills the trader. There was a recentering that went there, which makes it a little bit more complex to have a look at, but the trader was able to get out for a few ticks. And that is an interesting point just to bring up here before we come back to value, is about recentering. If you're trading a very fast market, it can actually be a hindrance to you to have it automatically recentered, particularly if you go to click on an exit trade and you think you're about to hit a certain bid or trade at a certain price. If the automatically recenters, you can get very badly burnt there. So my view is that you should do the centering of your DOM manually. But if we look at a situation just from a value trade, to come back to value, market had printed up, the trader's using his correlations, they're all going up. He came in 5 or 6 ticks behind where he saw the last print, and again, value in these faster markets is the last print. That's all we can use. It's not as robust as in a slower market, but that's all we can do. Last print, come in 5 or 6 ticks away, gets filled quickly, and is able to get out for a few ticks profit. Notice in this way, it doesn't really matter what price we're trading at. So as everybody else is trying to work out what levels are important, where all those kind of things are, we just say, where's the last print? Can I buy it below? He puts a bid in 4, 5, 6 ticks away. It doesn't matter what the price is. We just buy below value, sell above value. It means that every potential price is an opportunity for us. We're not just limiting ourselves to certain so-called key levels, and we can just trade anywhere. You should find that as a trader more liberating. So it's really just about order placement with these faster markets. The last print tells you roughly where value is. That's what we're going to use as our guide for value, the last print. And then it's a case of judging how far away to place your order to get a good feel to make enough ticks that it makes worthwhile, and not that the market goes through you too much. In this instance, the trader got that just about right and ended up with a good trade.